Hello and welcome to Moneylife. This is Sucheta Dalal. This time we're talking about the capital market. You would have thought that after the pandemic, it would scare investors away. We know that nothing of that sort is happening. Stock prices are booming. It's almost as though the stock market is completely disconnected from ground reality. But what is even more interesting is that there's a wave of retail investors, new investors who come into the market. And this is in spite of us seeing the highest number of broker defaults in the last 15 years. So we thought that we moved into a safe and secure market, but the same old problems about misappropriation of retail investors' money and shares has happened in such a large scale in the last 4 years that you've had innumerable defaults, but nothing seems to worry people. This is interesting because it's not just an Indian phenomenon, it's happening globally. Markets are booming all over the world with a whole new bunch of people entering the market because they think that is where they're going to make money. In India too, apparently 1 million new demat accounts have been opened. This is what the Securities and Exchange Board of India Chairman Ajay Tyagi said at a recent conference. India has traditionally had very low retail participation, especially after the 90s, because people have got repeatedly hit in a variety of scams and stayed away. I mean, believe it or not, even after the big increase in money that's gone to mutual funds, India has barely 2.8 crore investors, which is really lower than the global average. In fact, 2% of the population invests in the market. These numbers are going to change, not very significantly, but 1 million new demat accounts in a lockdown post-pandemic, what does it tell you? It tells you that there are two Indias. There is one which is living very comfortably, has a lot of money, working from home, has nothing else to do, so no cinemas, no travel, plenty of family time because you're with the family all the time. And what do? They want to increase their income by coming into the market, and they're probably dipping their feet for the first time. How is it all going to pan out? Well, let's take a look. Now, the interesting thing is that these retail investors are not looking at long-term value buying. In fact, Bloomberg has quoted CJ George of Geojit saying that many of these he says, retail trading is becoming some kind of gaming activity. Lots of youngsters, instead of playing games, are playing in the stock market. Doesn't sound good, right? Because it's all going to have a bad fallout. Hopefully, they'll be smart, they'll be mature, and they will not go through what happened to investors in. Look at the number of broking companies that have failed. Amrapali Adya, Kasaf Invest, Unicorn, Vasanthi Securities, Royal International, Click to Trade, Fiscus, Allied Financial, which in fact took down IL&FS Securities, Modex, Fair Wealth, Wealth Mantra, CRP Capital. Then of course Karvi, which is still an outstanding issue, we'll come to that, and more recently India Nivesh. Doesn't worry people. Now, what is the regulator doing to protect people? The regulator acts after the fact. So after these brokerage houses have closed down, it has tightened things so that the capacity for brokers to misuse investor funds is grossly reduced. So after 1st September, the exchanges tell us that 70 to 80% of shares lying with brokers in pool accounts for margin will have to be moved back to investor accounts. Investors will have to specifically pledge them, pay margins, and only then in advance, and only then can they trade. This is safer because it is going to give less of an opportunity for brokers to misuse funds. Except for the amount paid as margin, the small amount of less than about 30% will be at risk. The rest of it is not going to be affected. This doesn't save people from their own stupidity, which means bilateral agreements that they have with people where brokers have convinced people that if you have shares lying in a demat account, that's a dead investment. If you allow us to use them as margins and put in a pool account, we'll pay you a small amount of money. Lots of people have fallen for it. In fact, if you look at what happened with Karvi, just as a recap, this is a 2,300 crore problem. In November 2019, there was an investigation. SEBI stopped Karvi from accepting new clients. it was discovered that Karvi had raised money by pledging a whole bunch of securities, over 1500 crores worth, with three banks and a finance company: ICICI Bank, HDFC, IndusInd Bank, and Bajaj Finance. Now, before these people, these banks and NBFC could lay claim on it, SEBI ordered the depository to return the money to investors. A very good move, well done in time to protect retail investors who were defenseless, who had no idea that their shares had been pledged by Karvi, and so they got their shares back, 83,000 of them. But about 7,000 odd people have been waiting for their shares. Now, I sent out a tweet to collect data to figure out what kind of people had not got their money. Because remember, Karvi has been repeatedly given time to pay back. It has assured exchanges and the regulator that it's going to divest some other holdings that it has. It has a lot of assets, it's a large group, and it is going to pay back investors. But from November to now middle of August is a long time, and people have not got their money. What I found interesting is that a lot of people who haven't got their shares are senior citizens who have not even been able to email me. The emails have come from their sons or daughters. Why are these people involved in a deal with Karvi? Is it that their shares were taken without their permission? Nobody is saying that. Very few people are saying that they have gone and complained. Many of them just say, these are our shares, we need them back. So there is apprehension that people knowingly allowed themselves to be persuaded that this dead stock, if given to brokers, can get them some money. This is the kind of bilateral trades that are dangerous. And you have to remember that none of this, when people enter the market, they are constantly told that the market is so safe and secure. There are multiple guarantees. There's a settlement guarantee, trade guarantee, and there's an investor protection fund in case you lose money. I think we need to look at some of these numbers. So what is the amount outstanding in Karvi? According to, again, a statement made by the SEBI chairman, it is over 600 crores. That's a balance. I think there's still an amount that has to be paid to the banks. So if 600 crore has to go to investors, let's look at a few numbers and see how does this compare with what money is available with exchanges in the investor protection fund. As it turns out, the National Stock Exchange has 594.12 crore as of end March 2019. Bombay Stock Exchange, though significantly smaller, counts which is 10% of trading, it has a much larger number. It is 727.59 crore. In fact, the amount of money paid out by the BSE for broker defaults has been significantly less. Most of the problems have happened on the NSE. Of course, the NSE argues that if most of the business happens on the NSE, then the defaults and the problems are also going to happen on the NSE. Now, like I said, the SEBI chairman said 678 crore is the Karvi gap. Karvi has not been declared a defaulter. We know that in Allied and IL&FS itself, the problem is over 400 crore, right? And if this money has eventually got to be paid out of investor protection funds, the fund is not going to be enough. But remember, anyone who thinks that I'm going to be protected if my broker defaults is kidding themselves. There are lots of rules. The exchange only pays out after brokers declare a defaulter and for transactions that happen on the exchange. Usually in the cash market, small amount of margins if it is derivatives trading, right? This has a cap of 25 lakhs if it's a National Stock Exchange and 15 lakhs if it is the Bombay Stock Exchange, which means that if you enter into bilateral trades about your life savings, you can at best get 25 lakhs. This is borne out by the kind of payouts. So this table that we are showing you, NSE last year paid out about 100 crores to investors. It's a huge number if you ask me. At 25 lakhs per head, it tells you how many broker defaults have been there. The year after, it paid out 86 crore. Now you have two big ones where we don't know what's going to happen. Karvi assures us, C. Parthasarathi has told me on email that there is an intention to pay. Even the exchanges believe that he will liquidate other assets. He's unwell just now, but he is going to pay. So let's keep our fingers crossed on that one. But if that happens, Don't look at the investor protection funds of exchanges. They are going to give you only 25 lakhs. I'm saying all this because this rush of new investors who have come into the market, every time they come in, it's usually a bull market phenomenon. This is a once in a lifetime thing where new investors are rushing in what ought to be a worrying time, a lockdown, a pandemic. We've not seen it, most of us and even our parents have not seen it in their lifetime, and yet people are rushing in like there is no tomorrow. So what is it that these investors have to worry about? Remember, we still have SEBI looking at margins and what brokers are doing. What about what banks are doing? When it comes to Carvey also, banks agreed to allow them to pledge without verifying enough. Has the RBI acted against the banks? There is nothing in the public domain. There's silence. They have the money to go to court, so there is litigation. What has happened in India, Nivesh, which I talked about in my previous blog, is a 100 crore hole in the books of Edelweiss Custodial Services. HDFC Bank has not paid up the money, and apparently a fixed deposit which was supposed to be there as margin money turns out to be a loan. So a short-term loan is masquerading as a fixed deposit. We would have liked to see SEBI raising its eyebrows, conducting an open investigation and at least frowning on this practice. We don't know what's going to happen. Banks are powerful. Will they influence RBI and SEBI to do nothing more than a tap on the wrist and nothing in the public domain? This is a lesson to you that you have to be, as the Prime Minister would say, Atmanirbhar. You have to protect yourself, you have to take care of yourself and not even depend on the regulator to come to your rescue. Now, the other thing that banks do is they're constantly luring you to leverage your position. So new people are in the market's going up. When markets go up, everybody fancies themselves to be a genius. They do a short online course, they're ready to trade, they get tips on their WhatsApp, and what happens? The consequences are known only if things crash. Now, if overnight a big brokerage firm shuts down, which has existed for 14 years, shuts down its business and walks out of the market, let's not believe it's not going to happen to retail investors. And yet, every bank is out with digital mailers and relationship managers persuading people to borrow against their mutual funds and against their fixed deposits. This is as stupid as taking a gold loan. This is your core asset, this is your long-term saving, and you're not liquidating it. You can liquidate it and use it for margin. No, you're going to pay an interest to the bank and borrow against it. There's nothing more silly than that, but the large number of mailers that hit my mailbox every day shows that this is a popular product, and relationship managers are obviously convincing people that this is what is happening. So everything that should not happen, manipulation of penny stocks, treating the markets like a casino, leveraging positions by going out of the market, doing bilateral deals which will never be paid back if there is an issue, so that it's your own problem if you lose money. All of it is happening. I can only say all the best, folks. I hope you know what you're doing and that you come out of it successfully. Thank you.